very special broadcast. We are here to discuss the Q4 GDP numbers that have just been put out by the NSO and also the FY23 number, which has come in at quite a pleasant surprise at 7.2%. Now, this versus the 9.1% that we had seen in FY22, but that number coming in, which is really interesting because that is something that everyone was looking out for. And to discuss this further, joining me now is Saugata Bhattacharya, the Executive VP and Chief Economist at Axis Bank, Gurmeet Chadha, the Managing Partner and CIO at Compcircle, as well as Nasser Salim, the Managing Partner at Flexi Capital, and Mayank, Senior Economist at HDFC Bank. Thank you so much, gentlemen, for joining us live on this broadcast here at Moneycontrol. Of course, that number is looking quite nice to everyone who has to see it at first glance, but we also have other external factors like the RBI just pointed out. You have your global slowdown amongst advanced economies. We're seeing the fear of recession. Germany announcing that it's getting into a recession. So what does this number really tell us, and should we be celebrating already? I'll put this question first to Saugata Bhattacharya.
Thank you, Stacy. Thank you for having me on your show. This is expected. I think Axis Bank, we were 5.7% for Q4 and exactly 7.2% for the full year. This was on the back of higher than expected manufacturing, mining, a little bit on construction. But FY23 is past us. I mean, it's over and done. Growth momentum indicators that we are now seeing, leading indicators, concurrent indicators, etc., still suggest a fair bit of resilience in the system. The Q4 financial results of companies still show very good both top line and bottom line growth. I think going forward, I think we are forecasting a little bit lower growth at around 6%, but with upside. I think we are looking at a 6% baseline scenario for FY24 growth, because for one, there are risks coming in from an uneven monsoon, uneven distribution of rainfall. So that's one. The second is from a weak global economy. I think that's the most important bit, because our merchandise exports in particular are likely to suffer. So that export minus import component is not likely to be very strong in FY24, given a global slowdown. So we are looking at a 6%, lower than the RBI 6.5% prediction. But I think there are upside risks. Inflation will remain very low. So I think India is in a very good spot, even with a slower growth in FY24.
Right. Let me also get in Mayank's view on this. What was HDFC looking at, and that number, is it coming as a pleasant surprise, you would say?
Yeah, indeed. And I think, as Saugata sir said, that, basically, we were a little more conservative in the sense that our growth numbers were 6.9%. But yeah, it's a pleasant surprise. One of the things I think it's a story of, if I take the example of the IPL. So this is, the story of a strong first quarter where, was the power play overs. And then in the end, these are the slog overs where Q4 numbers are relatively strong. The middle two quarters were, thereabouts. But I think, going forward, the headwind from one obviously is the, what Saugata sir said, is the external bit. The second part is also the risk in the agriculture side. So the risk of El Nino, and even the Met Department, what they have predicted. So although they're saying it's normal, but it's tilted towards the negative end of the normal spectrum. So those are the risks. So for FY24, we are going at slightly just marginally low than what sir mentioned at 5.9%. But yeah, it indeed is a pleasant surprise, and it's broad-based. If you see all the sectors, it's broad-based recovery.
Right. So let's just look at these numbers quarterly, and like you're saying, we are seeing that steady increase that has happened from the first quarter, where it was to the 4.4 that it was in the previous quarter, and now coming in at 6.1. I think this is that jump that no one was expecting. At least the consensus was somewhere in that 4.1 to 5.7 range, but coming in at 6.1, what could perhaps be the factors really pushing this growth? Maybe Saugata can take this question again.
So, I mean, I haven't really, frankly, I haven't looked at the details of the growth, but I can bet that manufacturing will have been relatively high. I think agriculture at 4% was a little bit higher than what we had expected. We were going with that normal trend rate of 3.5%. But I know that the higher numbers that we're looking at were coming largely from IIP in part of manufacturing and mining, and the steel and cement. Although cement growth had been relatively low, steel growth consumption and output had been high, and these are the proxies that we use for the construction industry. So these are the three essential sectors. The other sector that is we always tend to go wrong is the public administration and other services. I haven't really seen that number, but I presume that the higher growth that we had expected is also coming in from that, a part of which is government expenditure. So that's the broad sense that we get from these numbers.
That's right. So we're always looking at the final consumption. That is what is really going to be pushing this number forward. Is also what has really aided the number, you could say, is the services sector, which is often not, so given that much credit, one would say. Let me bring in Gurmeet to tell us how markets could be looking at this number, because this has definitely come as a positive as a whole for the economy. But when markets have to read these numbers, how differently do they look at it, and is this also going to be a thumbs up from the market side?
I think I'll break it down before I give the market verdict. I think what market will be happy with is that manufacturing continues to do well. I would have liked the number to be better than 4.5, but that number looks well. The trade, hotel, communication services, which is the service part, has actually done 9.1, so which is actually pre-COVID was down. So that I think market will be very happy with that sector, which is trade, commerce, hotel, tourism kind of names. The capital formation is above 8%, which means I think we are in an investment cycle. There have been various debates on whether, obviously, it is government-led. So I think that's, to me, is a very, very good number. And I think even the construction number, if you see, was double digit. What market would be slightly maybe, but would have been more happier is this private final consumption. This is only 2.8%, which means the propensity to spend is slightly lower. And I think that has got to do with some stress in the rural areas. So possibly the market would now look at hints of how the rural economy fares. So I think the crop has been good. We have to see how monsoons fare. And also, if you see the GVA and GDP disconnect, right? So GVA is basically the national income from supply side. You add taxes and you remove subsidies from GDP, you get GVA. I think that number is positive, and that I think market should give a thumbs up.
Let me also bring in Nasser Salim. Nasser, how would you look at it? Like you were saying that consumption number still, lagging behind just at 2% odd. So, do you think this is something we can blame inflation on? Because that, even though we say it's within RBI's comfort zone, it's perhaps not really showing on the field, especially when it comes to the rural segment.
Good evening, Stacy. Thank you very much for having me on your show. I think, that's a pertinent point. I think consumer price inflation, though, of course, has started to show some great numbers in terms of cooling off. I think if you look at the April 2023 number, the retail inflation number was 4.7 as against April of 22 as high as 7.79%. Rural consumption continues to be a little hit on account of, pure inflation numbers, comparatively going up. But if I look at broadly some of the other sectors which kind of determine the economy and the shape of the economy and how GDP is looking at and will expect to grow, is 3-4 points I'd like to bring in. Number one, I think, clearly, I mean, there is no doubt that manufacturing is going to continue to remain very, very, strong and robust in terms of picking up. But I think 3-4 other quick points. Bank credit, I think, is a very, very important number. If I were to look at the bank credit growth number between March of 2022 and Jan to March, for example, of 23, we saw 15.4% versus a 12.6. Now, that obviously shows that there is a lot of consumption picking up. There's manufacturing, which is boding well with it. The other quick point is capacity utilization, Stacy, which basically assesses the production, the manufacturing capacity being utilized. And again, if you look at those numbers between FY23, Q3, it was at 74.3. Quarter one FY22 was as low as 60. So there is a big number increase there as well. The other quick one is PMI manufacturing. We talk about PMI in general, but I think we should talk about PMI manufacturing again, which is looking very in expansionary zone, which is why today the broad expectation of the GDP number was 5.5 to about 5.7 is what everybody is saying, but obviously it's coming at 6.1. Some of these factors, indicators, were suggestive of the fact that we will be sweetly surprised, as the case may be. And one more very important thing, I think we must mention this: GST collections have been consistently going up. So if I look at numbers between Jan to March, we've had a number of 1.56 in Jan, 1.5 lakh crores in February, and 1.6 lakh crores in March again, which shows that the reason why today the GDP number is sweetly surprised us.
That's right. So the high frequency indicators are quite clearly telling us what we could have expected. But if I have to go back to RBI and what they were really factoring in now, according to RBI's projection, they were looking at a 7.8 number for the April-June quarter, and they had said anywhere above 7. They're looking at 6.2 for July to September and 6.1 from October to December. And then going back to January-March of 24, just at 5.9%. So this would overall take that GDP growth percentage to 6.5% for FY24. Are these numbers, telling a different picture, perhaps because if we have such big expectations, is RBI being too conservative here, and are they actually factoring in your other external headwinds at this point?
Stacy, yeah.
No, you can answer that question, and maybe I'll put that to Saugata as well after this.
Okay. So Stacy, clearly, since you've asked that question, see, GDP growth has come in, and that we're seeing in India today at the moment is coming in on account of global economic slowdown. I mean, there is no running away from it. And recessionary pressures in several countries. I mean, global challenges and a combination of geopolitical tensions, climate-related shocks, as we're aware of, and increased debt servicing obligations, Stacy, due to rising interest rates. And we've had challenges such as those, and obviously, I think the RBI has come in and looked at those numbers very carefully globally as well, and therefore the outlay for the number that they've given seems to be more realistic. Obviously, I think we would expect to believe that if our manufacturing and consumption and capacity utilization continues to show the robust growth it is, the numbers again will surprise us for the next financial year, or for the current financial year.
Right. So, Gata, maybe you want to come in and tell us a little bit more on how RBI would really react, and especially given their projection, this pretty much sits comfortably with what they were expecting.
So again, as I said before, that 6.5 was predicated on a 7% growth, GDP growth for FY23. Now it's come out at 7.2. So the base effect should automatically, if everything else remains the same, that base effect should pull growth down to 6.3. So this is just the algebra of it. The RBI is coming in. Remember, the way GDP is measured is that a lot of it comes in from the nominal GDP growth, which is measured from the results of for the non-agricultural sector, results of the financial, the companies, the financial results of publicly listed companies. They start with that, and then they use the GDP deflator, which is inflation basically, and then come down minus the inflation and then come down to the real rate. For FY24, inflation, WPI inflation is a big component of GDP. WPI inflation is likely to be near 1.5%, down from 9.7% in FY23. So that should boost the real GDP growth rate up if everything remains the same and we are still expecting fairly robust results, financial results from the listed companies. Despite a slowdown, I mean, there will be a slowdown, but still very robust. So that's probably the reason that the RBI is coming out with a higher than market consensus of 6.5% GDP growth. I think there is a fair chance that India hits 6.5%, but we should not be disappointed with a 6% growth in FY24, given there's a global slowdown. The global economy, as IMF predicts, is coming in only at around 2.8%. So in that environment, if we grow too fast, a whole lot of macro imbalances will begin to come in. our current account deficit will expand, the rupee becomes weaker, capital flows are still not very stable, etc. So in this environment, a moderate slowdown is actually good. So I mean, even if we hit a 6.2% or a 6.3% for FY24 GDP growth, it's completely okay.
Right. Let me also bring in some other data that came in just earlier today. We had the fiscal deficit data which came in, and FY23 fiscal deficit has come in at 6.4% of GDP. Now, well, this is meeting the government's target, we would say, of that 2.79 lakh crore rupees. But does this, where does this put the picture? Is this going to add pressure in terms of import export? Where are we going to stand with this number coming in at this time? Mayank, maybe you can take a go at it.
Yeah. So, frankly, the fiscal deficit, the latest numbers, I haven't gone through it in detail. But I think one thing is that the government meeting the target. I think government has been pretty sanguine about it, and they have been, very disciplined in this term. And I think that basically adds because the debt burden for the government goes down. But I think they have not what they have done is they have reduced the REVEX. So the capital expenditure is still going strong. So even if you see public administration, their expenditure, the growth is subdued at 3.1%, I think, this time. So what they are doing is they're putting that money in capital expenditure more. So that I think is going to be good, and they are on track to meet their fiscal deficit target as per the FRBM, which is I think 4.5% by FY26. So I think that's a net positive, and yeah.
Yeah, if I have to put out that number for March, the capex is coming at 1.46 lakh crore rupees. This against that 1.06 lakh crore rupees on a YOY basis. At least that's what the number is suggesting. But like we spoke about, there will be external headwinds, which is what is really going to be a big factor of how things go. Let me get a markets perspective once again. Let me get in Gurmeet here to tell us the street is perhaps going to give it a thumbs up tomorrow, if we have to say so. And we're seeing this rally as such. But how much of a difference will these external factors? We have the debt ceiling talks, which have kept things topsy-turvy. We're also seeing crude really change its face because of this. How much importance is this number that will come in, and how will it play out in the days to come?
No, the number is extremely positive, as I said, and this is in backdrop, as Saugata was making, that Germany is an official recession, 2 quarters of GDP contraction. We've seen producer price inflation falling in Germany, pointing to disinflationary trend. US, the debate is between a soft landing or a hard landing. And China data was weak. Nasser pointed out below 50 for China at 48.8 just a while back. So I think in this environment, anything in that 6.5% corridor for the next year is pretty solid. From a market point of view, we have seen almost 1,000-point movement on Nifty. FIs have bought more than 30,000 crores in May, and this has happened after a long time. And we have seen such aggressive selling in last 2 years. So I think some consolidation can obviously happen. And I think the bigger thing from these point of view is that government is adhering to the fiscal path. The deficit is on lines at 6.4% of GDP. The bond market should be happy. The tax collections, we saw GST crossing 18 lakh crores, is giving them that headroom and lesser subsidy, which is what is reflecting in the GVA, which is GDP plus taxes minus subsidy. And I think that overall, I think India remains one of the better places in this world when there is so much of depressed economic news. So market should be positive about it. Near-term movements very difficult to predict how it will react tomorrow or day after. But I think overall, I think India now looks in a relatively much better spot.
Maybe Saugata can throw some light on this GVA component, because we are seeing that number come in at 7% versus 8.8. So what does that really tell us?
So GVA is actually, Stacy, GVA is the number to watch, because that's really economic activity. GVA plus, as I think one of my co-panelists was saying. So the other one is GVA plus indirect taxes minus subsidies makes a GDP. The rest is taxes and subsidies, which are more government-oriented things. So the GVA is actually the key indicator of economic activity. And GVA being strong, I think reflects the part because all the numbers that you see from agriculture, mining, electricity, manufacturing, etc., and the services components actually are the GVA numbers. So the GVA number at 7, maybe a little bit of a moderation from the earlier 8.1%, etc., but it's still very, very strong. I mean, so that is not a matter of concern at all. And as I said before, I mean, the GVA is determined to a very large extent, particularly the non-agricultural GVA, services and manufacturing, from the results, the Q4 results of these companies, of the companies that we have seen. And that shows that till now, and this is buttressed, because that's a little backward looking, but the actual numbers, the PMIs, the GST collections, the EVU rates, etc., all of that shows that economic activity still remains very, very strong. And that's what we are hopeful. The only key risks, as all of us are mentioning, is from the external sector. If there is a sharp slowdown in merchandise exports to some of the key of our key exporting countries.
Right. So this question, I think, might not get a straight answer, but go ahead.
Yeah, just wanted to add on to what Saugata sir was saying, that in GVA, when we look at especially the finance, real estate, and professional services, this is where all your tech companies and all those come up. So that has gone up on it was 5.7% in Q3, and now it is 7.1% in Q4. So that is again a positive that really shows the resilience, because especially in the media there was a lot of news on there was some stress on the tech companies, but overall it just shows that the fundamentals are strong, and really the resilience of India's services and tech industry. So that also is a positive.
Right. Now we are definitely factoring those external factors, but we do have RBI's policy that is coming up later this week. How much of a difference will this number really change? Because we are hearing a lot of murmurs saying it's time to pause. We are reaching the end of that tightening cycle. So maybe Nasir, we'll hear from you first, and then I'll ask the others what they are anticipating to happen in this next policy meet.
So, Stacy, we at Flexi Capital feel that we've pretty much reached the end of the yield in terms of it going up further. If you look at all the indicators today we've just been speaking about repeatedly, sustained flows from foreign portfolio investors, improving growth prospects, good prospects for corporate earnings, and declining inflation. I mean, see, inflation was the main enemy, right? Which the RBI had to contain and control. But with the expectation of a rate cut by the end of 2023, and the fundamental support to the market today we are seeing is on account of interest rates, which have been, the last decision by the RBI was that they did not go and say we're going to increase rates. They had a very, very clear view to say that we are looking at pretty much end of the commentary was very, very clear to say that we are closely monitoring our inflation numbers, which have become positive in this case. And therefore, we feel that RBI will continue to maintain the same stand. We also feel that the announcement on the pivot by RBI is not going to be linked to the Fed announcement. They are two separate challenges. US has its own challenges. I don't think we're going to continue to follow what they do. And we feel that this is pretty much the end of the cycle, interest rate hike cycle. We will see an announcement in terms of pivot, if not this cycle, but possibly within the next 60 to 90 days.
Right. Well, gentlemen, we have the Chief Economic Advisor who started speaking, so we are going to cut to that feed. But I would really like to thank all of you all, Saugata Bhattacharya, Executive VP, Chief Economist at Axis Bank, Gurmeet Chadha, the Managing Partner at Compcircle, Nasser Salim, the Managing Partner at Flexi Capital, as well as Mayank, Senior Economist at HDFC Bank. Thank you so much, gentlemen, for giving us these insights. We are going to hear more from the CEO and how the government is really explaining these numbers to us, but we'll also be discussing this further in detail, a deep dive on Moneycontrol tomorrow once again. So I would like all our viewers to tune in then when we get into the details of these numbers. Thanks so much for tuning in.
of 35% year on year in Q4. And private consumption in Q4 might have dipped, but overall for the financial year, private consumption, a share of GDP, was at a high in about 16 years, as we showed earlier. Addition components and looking at the state of the health of agricultural sector. The food grain production based on second advance estimate for 22-23 is looking pretty good at 33 crore tons, 330 million tons, that is, or close to 300 million tons, I'm sorry, 300 million tons. And if you look at the middle top chart, the availability of water in reservoirs compared to 10-year average is 36% above the 10-year average in the southern region and more than 20% above 10-year average in the rest of the regions of the country. Seeds availability are plenty compared to the requirement, and there is adequate procurement of wheat in FY23. The sale of tractors continues to create double-digit growth rates, and therefore it augurs well for the growth of the agricultural sector, while of course many of us know that there is a prediction of an El Nino, but lately this prediction is being pushed back by meteorological agencies, which is good news for the overall development of the monsoon, and it soon should be setting in the western coast of the country. And fertilizer stocks are in comfortable position compared to the estimated requirement. If you look at the high frequency monthly data, PMI manufacturing has been expanding since the middle of 2021. And if you look at the index of industrial production and the core industries growth rate, naturally the chart looks somewhat on the flatter side simply because it is coming off a high base in Q1 of 21-22, but these growth rates are in high single digits or close to double digits in the case of the core in 8 core industries. Capacity utilization is expanding. In fact, in several sectors, it has already crossed 75%, which would necessitate either the expansion of existing capacity or creating new capacities in several sectors. Steel production and the index of cement production are rising, auguring well for construction sector and non-residential construction as well. Coming to services sector, starting from the top left, PMI services expanded at the fastest pace in 13 years in April. There is robust growth in ride-free traffic, which is also a good sign of industrial and manufacturing activity in the country. The hotel industry is doing quite well, as most of us would know who keep traveling. In fact, I understand from the industry participants that the total employment in the hospitality industry was 40 million before COVID, and during COVID it dipped to 29 million, and post-COVID recovery phase it has improved to 45 million in terms of employment, even exceeding the pre-COVID levels by more than 10%. And foreign tourist arrivals are now getting back to the average of the pre-pandemic level as we head into the new financial year, which has just started. And if you look at the private consumption, where in this chart, we plot the private final consumption expenditure pre-pandemic, and then the post-pandemic is the green line. And if the pre-pandemic trend had continued, where it would be is the red line that continues. And the post-pandemic trend is now catching up so well that it is exceeding the pre-pandemic trend line as well. So in other words, it is not as if we are lost permanently a certain trend growth in private final consumption expenditure. The acceleration in the post-pandemic period in the recovery of private final consumption expenditure has now caught up with what would have been the trend growth pre-pandemic had the pandemic not happened. In terms of rural demand, year-on-year growth in fast-moving consumer goods volume sales turned positive in Q4, signaling a pickup in rural demand, a very slight positive, but still a turnaround from the previous 3 quarters. And if you look at the agricultural and non-agricultural wages, on the right top, there is a blip on the upside, both in agri and non-agri wages in terms of the annual growth rates. And after moderating in February and March, the combined 2- and 3-wheeler sales picked up in April 2023. An increase in the minimum support price for major crops and a rise in the Mahatma Gandhi National Rural Employment Guarantee Scheme wage rate are expected to improve the financial security of rural households further and boost rural demand in the coming months. But more importantly, let me also point out that the index of cement and steel production showed us construction sector activity is pretty strong, as you will see later in the real estate sector trends. And therefore, much of the employment elasticity in the country comes from the construction sector. And that would also lead to migration of some of the workers who returned to their native villages during the pandemic to come back to urban India and resume their jobs in construction industry, etc. And that is also likely to contribute to income transfers from urban to rural India, and naturally resulting in consumption growth in the coming months and quarters in rural India as well. In terms of urban demand, passenger vehicle sales are picking up, and as you see on the right top, there is a pretty strong momentum in new launches of housing as well as sales. And domestic air passenger traffic in the financial year 22-23 had exceeded the trend in the previous 3 financial years. And also the spend on credit and debit cards are running at good rates. So overall, urban consumption demand is also growing quite briskly, as well as indications of strong recovery in the rural demand side, as well as we saw in the previous slide. Turning from demand side indicators to inflation management, while India did experience a spurt in the inflation rate in the first quarter of 22-23 because of the sharp pickup in commodity price due to the onset of conflict in Ukraine, by and large, India's deviation of the inflation rate from the target is one of the lowest, only beaten by Indonesia, whereas India is the one country after Indonesia which had the lowest deviation in terms of the inflation rate from its target. And the monetary policy tightening, therefore, didn't have to become extreme, and that is what, in a way, paves the way for a soft landing, which has already happened, and augurs well for growth prospects in the current financial year as well. As far as the inflation outlook is concerned, many of you would have already noticed the RBI annual report released earlier today, and overall the WPI inflation rate is actually in negative territory, and consumer price index is within the tolerance band of the Reserve Bank of India. As we expect commodity prices to remain somewhat subdued globally, I think the pass-through from WPI to CPI will also be restrained, and there is a very high chance that the consumer price index inflation rate comes back and closer to the RBI's midpoint of 4% rather than staying above 5% in the course of the current financial year. India's inflation forecast, therefore, excepting for ADB, all other forecasts are pointing on an average to a number that is at the midpoint of the range of between 4 and 6 on the upper end towards 5%. And the food and the core inflation both are also declining. Of course, some of us would point out that monsoon could be a risk, but that is where we showed that the irrigation levels and the estimates of production and the buffer stocks, etc., are all pointing to a lot of risk management, risk mitigation parameters that would keep any potential impact of a weaker monsoon, if it were to happen, on the price side and the output side muted. So inflation trajectory will be influenced going forward by the following factors: pass-through of lower input costs, bumper harvest, healthy prospects for Kharif season, and internationally commodity prices are expected to decline in 2023, even if they are still higher in absolute terms than the pre-pandemic levels. turning from domestic demand and inflation to external situation. Merchandise export growth, as expected, were lower in Q2 and Q3, but in Q4 it staged quarter-on-quarter recovery, even better than the Q2 levels, which is, I think, a good sign given slowing global demand, and that has contributed to a moderating merchandise trade deficit. But more importantly, all of us know that the surplus in services trade has been rising, which is what is contributing to a very subdued expectations of current account deficit, even for the current financial year, with many forecasters pointing to a number that will be less than 2%, that will be even better than 2% of GDP for the current account deficit in 23-24. And after some hesitation on the part of the foreign portfolio investors in the closing months of the calendar year 2022, they have returned to the Indian market, sensing the importance and the virtues of macroeconomic stability, higher growth rates compared to major economic powers, and overall financial and macro stability. And the forex reserves, which declined during the course of the last financial year, especially in the first half, are coming closer to the kind of peak levels we saw in April-May 2022, heading towards $600 billion on the back of a declining trade deficit and improving foreign portfolio investment flows. Well, all of us have been waiting for the capital formation in the private sector to pick up. One of the important leading indicators is the import of capital goods, even not more than the overall import numbers. We keep track of the import of capital goods, which actually did underperform in the second decade of last year, is the second decade of this millennium, which is what reflected in the low capital formation because of balance sheet problems faced by the corporate sector. But now in the current financial year ending March 2023, capital goods imports picked up quite well compared to the previous year, growing by almost 20%. And increased production of capital goods domestically and construction and infrastructure good index complement the growth in the import of capital goods, auguring very well for a pickup in the private sector capital formation, which is what we see in the new project announcements by the private sector, captured in many other private databases as well. And bottom-up data based on the financial results of companies submitted for March 2023 indicate that private sector capital formation is beginning to unfold. And as we get full data for the corporate sector in the coming months, we will see that it is no longer a prospective story, but a current reality, that the private sector capital formation cycle on the back of high capacity utilization and robust demand has begun to take place already. And as you can see on the right side, growth in private investment in several sectors in FY23 compared to FY22 are listed here, excepting the three sectors in the bottom. Every other sector has seen a healthy improvement in capital formation rates in FY23. Today also we saw the release of the fiscal deficit numbers. In fact, for the financial year ending March 23, in terms of two decimal places, it would have been 6.36%, but it is 6.4 in terms of first decimal place as budgeted and as revised. And therefore, we are on track on the back of sustained economic growth to achieve 5.9% budgeted for the current financial year. And that is why the continued emphasis on capital expenditure will also be expanding the potential growth rate of the economy, contributing to prospects for non-inflationary sustained economic growth in the remainder of the decade. And that is what is also signaled by the fact that financial cycle in India, which went through a downturn in the second decade, has also turned the corner, as we will see later, and a combination of better financial health in the banking and in the non-banking sector, and the infrastructure improvement contributing to removal of bottlenecks, and private sector capital formation catching up to meet increased demand, should actually augur very well for an elongated economic cycle in the country than in the previous decades. On the fiscal front, of course, apart from the capital expenditure thrust, also the brighter picture comes from the improvement in corporate tax collections and in the personal income tax collections, both of which are growing neck to neck in terms of the actual tax collected, both from the corporate sector and from the personal sector. And on the indirect taxes side, of course, goods and services tax, the average level shift apart from the pandemic year has been noticeably sharper even in 22-23 and beginning quite well for 23-24 as well. In terms of labor market, the quarterly urban unemployment rate is down from a peak of 21% or 20.8 in the pandemic-induced, pandemic-heavy quarter of April-June 2020, down to 6.8% in the quarter ending March 2023. In terms of the creation of formal employment, based on the average net additions to the Employee Provident Fund organization, you can see that the FY23 average level has been much higher than the previous 3 financial years, and these are good indicators of the health of the labor market in India. And in terms of a start to the current financial year, we did mention in the monthly economic report which we put out, the April monthly economic report was released in the 3rd week of May, and we did say that while in the economic survey, we mentioned that 6.5% was our target or an estimate of the real GDP growth for this financial year, but we also mentioned that the risks to the downside were higher. But now we are prepared to stick our neck out one more time and say that the risks to 6.5% are probably more evenly balanced. That is, there is as good a chance that this number may be exceeded as there is a chance that the reality may undershoot this number. So we are prepared to say that the risks are more evenly balanced than what we felt 4 months ago, and the high frequency indicators for industry, services, external sector, fiscal and credit growth are all pointing to sustained momentum in the economy. Growth prospects therefore appear bright. External factors, as the RBI's annual report also indicated, pose downside risks because of geopolitics, because of what might happen to oil production, and also due to potential for further monetary tightening in some developed countries, and with it the attendant risks of further financial stress. But those are external factors which are well provided for in terms of the resilience of domestic demand growth in India. So our expectation is that private sector will continue to expand its investment plans. Public digital goods platforms will also keep expanding, along with last mile connectivity and logistics reforms on the back of the sustained investment in infrastructure, which has grown by 3 times through public capex spending. All of these provide important buffers against the external risks that we point out in this slide. The growth projection, just to share with you what each different agencies have, 6.5% is the estimate of Reserve Bank of India as well as the Ministry of Finance here. And RBI, the Asian Development Bank and the World Bank are quite close, whereas the credit rating agencies are at 6, IMF is at 5.9, and OECD is 5.7. But I reiterate, our number is 6.5%, and the risks are evenly balanced between the downside and the upside to this estimate. Thank you very much. So we are very pleased to have been able to present a story of both sustained economic momentum combined with macroeconomic, financial and fiscal stability, and we look forward to another year of solid economic performance by India. Thank you very much. Now I am ready to take your questions.
We begin with Arup Roy Chaudhary, Business Standard.
दुनिया में जहाँ अधिक मंदी है वहाँ भारत इस तेज गति से विकास कर रहा है। इस गलत में चाहे लेकिन भी नहीं कर रहा है और कार्यक्रमों का सिलसिला लगातार जारी है। नमस्कार।
I think it's coming from the DB feed. I think it's a Doordarshan feed which is sort of.
I think you'll have to unmute that.